Hey everyone, welcome back to Corporate Decoder. Today, Medline Inc. MDLN just filed an 8K reporting on significant debt refinancing and a stock offering. And I think there is one key detail regarding the debt that warrants a closer look. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is using debt to grow, but the terms of this new debt raise some questions about how they are managing risk. Medline Incorporated is essentially updating us on two major financial events that happened recently. First, they issued a lot of new debt, and second, some big shareholders sold a chunk of their stock. Let's break down what this debt refinancing means for the company. So, on May 28th of 2026, Medline Borrower LP and Medline Co-Issuer Incorporated, which are part of Medline Inc., they issued a huge amount of new debt. We're talking about $1.25 billion in what they call senior secured notes due in 2031, and another $750 million in senior secured notes due in 2033. Together, these notes add up to a massive $2 billion. This new debt was issued under something called an indenture, which is basically a fancy contract. And at the same time they did this, they also refinanced their existing loan facility that was due in 2030. They replaced that with a new loan facility. This new loan facility, along with their existing credit line, makes up what they call the senior secured credit facilities. Now, why did they take on all this new debt? The money they raised from selling these notes, plus money from the new loan facility and their own cash, was used for a few big things. They paid off all the debt from a loan facility that was due in 2028. They also refinanced a big chunk of that older loan facility that was set to mature in 2030. Plus, they bought back about $500 million of their old notes that were due in 2029. And of course, they paid all the fees and costs associated with all these transactions. So, the new notes are secured by pretty much all of the company's assets. This means if Medline has trouble paying its debts, the people who lent them money have a claim on those assets. This collateral also backs up other existing debts, including other loans and older notes. It is all on a Pari Passu basis, which simply means they all rank equally in terms of priority for getting paid back from the collateral. Let's talk about the interest rates. The notes due in 2031 will pay 5% interest per year, and the notes due in 2033 will pay 5.25%. This interest is paid twice a year on June 15th and December 15th. The 2031 notes are due to mature in June of 2031, and the 2033 notes are due in June of 2033. These new notes are also guaranteed by the parent company and other subsidiaries, meaning they are on the hook to pay if the main issuers can't. Now, here is where it gets interesting. The assets that secure these new notes are also used to secure their other credit facilities and older notes. There is a special agreement called the Pari Passu Intercreditor Agreement that lays out how all these different lenders share the collateral if things go wrong. This agreement means that in case of default, all these secured lenders get paid from the collateral on an equal footing. Essentially, these new notes are designated as senior secured obligations. This means they are at the top of the list for repayment for the company itself, ranking equally with other senior debts. They are also effectively senior to any unsecured debt. However, they are structurally subordinate to any debt or liabilities owed by subsidiaries that are not guarantors of these new notes. So, while they are secured, there are layers of priority to consider. Medline has the option to redeem these notes early. For the 2031 notes, they can pay them back anytime before May of 2031. The price they'd pay would be either the full original amount plus any unpaid interest, or a make-whole price, which is usually set to compensate lenders for giving up their future interest payments. After May 2031, they can redeem them at the full principal amount plus interest. The same applies to the 2033 notes, with slightly different dates. There is also a change of control clause. If a major event happens that changes who controls Medline, they might have to offer to buy back these notes from investors at a slightly higher price, specifically 101% of the original amount, plus any accrued interest. This protects investors if the company's ownership changes significantly. The agreement, the indenture, also comes with certain rules or covenants that Medline has to follow. These rules restrict their ability to take on more debt secured by certain assets, to sell off most of their assets, or to merge with other companies without lender approval. There are also rules about what happens if they don't follow these covenants, which are called events of default. If an event of default happens, the entire loan amount plus unpaid interest could become due immediately. Now, let's quickly touch on the other part of this filing. Besides issuing new debt, Medline also amended their existing credit agreement. This amendment, dated May 28, 2026, officially put in place the refinancing of that older term loan facility. The new loan facility will mature in May of 2033 and carries similar rules and covenants as the old one. The interest rate on this new loan facility can be based on either a general base rate or a rate called term SOFR, which is tied to short-term interest rate benchmarks. There is a floor on the SOFR rate, meaning it won't go below 0.50%. This is a common feature to protect lenders if interest rates fall very low. There is also a prepayment penalty. If Medline decides to pay off some of this new loan facility within 6 months of the amendment date, there is a 1% fee on the amount they prepay. This is to discourage early payoffs that might be beneficial for the company, but less so for the banks. Essentially, this section just confirms that the new debt issuance and the credit agreement amendment are direct financial obligations for Medline. All the details we just discussed about the notes, the indenture, and the credit agreement amendment fall under this. Now, this is a separate but related development. On the same day, May 28th, 2026, some major shareholders affiliated with big investment firms like Blackstone and Hellman and Friedman, along with a fund from Abu Dhabi, they sold a massive amount of Medline's Class A common stock. They sold over 72 million shares at $37 a share. The underwriters also had an option to buy even more shares. This is often called a secondary offering, where existing owners sell their shares to the public, not the company itself raising money. Interestingly, because some of these big investors and the underwriters themselves have significant stakes in Medline, there were potential conflicts of interest. This is a regulatory thing that requires specific disclosures. In this case, they had to follow extra rules. But they determined that a qualified independent underwriter wasn't needed because there was already a public market for Medline stock. This just means the regulators are keeping an eye on these large capital market transactions involving influential parties. And finally, this section just lists all the official documents that back up everything we've talked about. It includes the full text of the indenture for the new notes, the forms of those notes themselves, and the amendment to the credit agreement. So, looking at this filing, Medline is actively using debt to manage its balance sheet and operations. They've taken on $2 billion in new secured debt and also refinanced a significant portion of their existing credit facility. On the other hand, major shareholders took advantage of the market to sell a large chunk of their stock. What does this mean for Medline? Well, issuing new debt, especially secured debt, is a common strategy for companies looking to fund operations, acquisitions, or recapitalizations. The fact that these new notes are secured and rank pari passu with other senior debts means that lenders have a strong claim on the company's assets. The interest rates of 5% and 5.25% are not insignificant, and they add a considerable fixed cost to the company's balance sheet. This new debt will need to be serviced consistently, and any misstep in revenue or profitability could put pressure on their ability to meet these obligations. The refinancing of the older term loan facility is likely aimed at either securing better terms, extending maturities, or lowering the overall cost of borrowing. The fact that they are extending the maturity of a significant portion of their debt out to 2033 is a strategic move to provide longer-term financial stability. However, the 1% prepayment penalty in the first 6 months of the new credit facility suggests the company might be contemplating further strategic moves. Or perhaps the lenders wanted to lock in their returns for at least that period. The secondary offering by major shareholders is also a notable event. It indicates that significant private equity players like Blackstone and Hellman and Friedman are realizing some of their investments, while this can sometimes signal confidence in the company's future prospects. It can also be seen as a sign that these sophisticated investors believe the current market valuation is favorable for exiting parts of their positions. Given the recent news headlines about large holders selling, this aligns with a trend of substantial equity divestment by these affiliated entities. My biggest concern here is the sheer amount of secured debt and the associated interest burden. While the company is leveraging its assets to gain financial flexibility, it also increases financial risk. A significant downturn in the healthcare sector or operational challenges could strain their ability to manage both the interest payments and principal repayments on this substantial debt load. The company is effectively taking on more leverage at a time when interest rates, though potentially stabilizing, have been historically higher than in prior years. What I am actually looking for is how this increased debt load impacts Medline's profitability and its ability to generate free cash flow over the next few quarters to service its obligations. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.